Today's Trader Academy introduces a new course called Introduction to Technical Analysis. This course has been created by Adam Grimes, who is a partner at Market Life Trading and CIO of Waverly Advisors. In this course, you will learn the basics of reading a price chart, explore moving averages, and learn how to monitor extension and momentum using bands and channels. Adam will walk through popular indicators such as RSI, MACD, and stochastics. Lastly, he'll discuss measuring volatility and how to implement order types to execute a plan. Each lesson is followed by a quiz, and there'll be a final at the end of the last lesson to help you better understand the subject matter.
Hello, I'm Adam Grimes, and welcome to Interactive Brokers Traders Academy. This course is Introduction to Technical Analysis, and here in Unit 1, Technical Analysis, What and Why, we're going to first consider why are people involved in markets? What's the goal of all trading and investing? Next, we're going to think about an edge. What is an edge in the market? Where do people look for and find an edge? And last, what is technical analysis? So if we think about why people get involved in markets, we might be inclined to give a simple answer and say, well, people trade and invest to make money. Yes, that is true, but is there more? And in fact, there is. The main reason that financial markets exist is price discovery. If we had no markets, or if we had no liquidity in markets, and what that means is people meeting and trading, buying and selling with disagreement and agreement, we wouldn't know what anything is worth. And so this is one of the main functions of markets, why markets exist. People and institutions participate in markets for many different reasons. In the process of this price discovery, people are buying and selling commodities, and commodities would be wheat, corn, precious metals, different things that are needed in different aspects of industry. You can imagine a wheat farmer that might have a lot of wheat to sell. Furthermore, if that price was favorable for that farmer might want to lock the price in. And this is hedging. There are different ways to hedge in markets. Same thing with a consumer, somebody who knows he or she is going to need to buy a lot of wheat to make bread or cereal or something, can buy at a specific price in the future. And this is one of the reasons that markets exist, to offset that kind of risk of price change. And there are many different risks. People can offset risks with currencies, with options, with stocks, with playing off various indexes against each other or individual stocks. So there might be reasons, and there certainly are reasons, that people make trades in markets that go beyond simply speculative reasons and looking to make money, though that is a reason that markets exist. So why spend time on this? Well, we just need to be careful, because when you learn an analytical framework, when you learn a way to look at the market, to look at data, to think about the market, it's very easy to assume that everyone is seeing the markets as you are. And just be aware that is not true. That certainly is not true. Switching gears just a little bit, what is an edge? Well, if we're going to make money in markets, we must have an edge. And what is an edge? An edge is simply a higher probability of one thing happening than another. Now, what is this one thing? We might be, again, thinking first steps very simply. We might think, well, an edge is going to tell us if something is going to go up or down. That is, in fact, one kind of edge. That's a directional edge. We might have a set of conditions that show us there's a higher probability of a market going up or down over some time frame. But there are other edges. There are edges that might say a market will not move. It's not likely to move. And actually, that's an important linguistic point. We need to be careful about saying that anything is going to happen in the future. Everything we do is really an application of probability. So any edge we have shows us a tilt in probability or a higher chance of one thing happening than another. That one thing could also be a certain kind of volatility. It could be a certain kind of movement. It could be a movement between related markets. So just, again, be careful about that first step of tending to think that an edge tells you if a market's going to go up or down. That's one kind of edge. there are others. When we start to look at an edge and to try to understand the edge, this is a formula that we use. This formula is called expected value. Sometimes you'll see it called expectancy. And it has two parts. The first part is the probability of a win, so your percentage of winning trades, times the average size of a win. And subtracted from that is the probability of a losing trade times the average losing trade. Now, the winning and losing probabilities may not sum to 1 because there may be some break-even trades. Those do not need to be included in this formula because you'd be multiplying by 0. By definition, your break-even trade would be 0. So what does this formula tell us? Well, over a large sample of trades, this is how much we are likely to make or lose on each individual trade. This expected value is the bottom line. You can derive it from your actual trading. If you have a record of many trades, you can calculate your expected value. You also could calculate it from a back test, but we also need to consider where these numbers come from, how reliable are they? In other words, just to put it very simply, any back test is probably a little bit suspect, where if you're looking at numbers that actually come from real trades moving in and out of the market, those are going to be more reliable than something from a theoretical backtest. One of the other interesting things we can do, and the reason we start with a formula, which I know is maybe not a terribly exciting way to start a course, but the reason we start with the formula is because you can see there are two things that have an impact on overall profitability. And one is the percentage of winning trades. And you need to be careful because people think that either of these is the complete answer. One is the percentage of winning trades. The second is what we might call your reward to risk ratio, having a much bigger win than a loss, or the percentage of winning trades is having a high percentage of winning trades. If you plug numbers in and play with this formula, you will see that it is not necessary to get this expectancy to be positive. You don't have to have a huge percentage of winning trades if your average win is large enough relative to your average loss. Similarly, you can have an average win that is smaller than your average loss if you have a higher percentage of winning trades and losing trades. So there is not one way, there's not one best way to get a positive expected value. But if you're trading and the bottom line of this equation is negative, you will not be making money. So where do people look for a positive edge? Technical analysis obviously is one answer. Fundamental analysis is another. What is fundamental analysis? That's using economic data, using financial data released from companies to try to figure out how the business conditions, how the competitive advantage might change in the future, and what's the company worth. Macro analysis, macroeconomics, is doing the same thing, but on more of a geopolitical level and trying to understand what sorts of shifts might happen in politics and policy that could change values around the world. Relative value trading, so this is trading two things against each other, whether it's a spread between two stocks or a spread between different commodities, different months of a commodity. People also sometimes have deep specialized expertise. You might imagine somebody with a medical background who finds an edge trading medical stocks. Some people anticipate news, anticipate shifts. For instance, back to the medical example, maybe something happening with an FDA approval for a drug, and some people have expertise. Arbitrage is another possibility. This is basically free money, which does not exist in sizable quantities or for very long. So if you think you found an arbitrage opportunity, be careful. What is technical analysis? Well, this is our focus. Technical analysis is looking for an edge based on patterns in prices. Some people say patterns in past prices, but that's a little bit redundant because you can't see future prices. That would solve everything, right? Traditional technical analysis is primarily visual, looking at patterns on charts. Traditional technical analysis also includes an element of subjectivity because you are looking at patterns on charts. This is what most people think technical analysis is. It's looking at rectangles and heads and shoulders patterns and wedges. And this is, in fact, one aspect of technical analysis, but there certainly are other forms. Technical analysis is a discipline that covers a very wide range of techniques, from classical charting to statistical quantitative driven approaches. I would argue that what a lot of people might call quantitative is actually technical analysis. Why? Because we're using patterns in prices or patterns in returns in some cases to find that positive edge. Price action, market structure, different indicators, a lot of different techniques and tools, and we're going to look at those over the rest of this course. Quick review. People participate in markets for many reasons. Be careful of thinking everybody sees markets like you do. The expected value of your system is the bottom line. You can find that expected value through a reward to risk ratio or through a higher probability of a win than loss. That number just must be positive. There are many approaches to finding this positive edge in the market, and technical analysis is certainly one of those. Technical analysis covers a wide range of techniques, perspectives, and philosophies. Thank you very much.